Okay, in part 2 of Chapter 16 lecture, I wanted to pick up where we left off, and that is talking about the 3 different types of confirmations. So this is kind of the last part of the reading that I want you to be responsible for in Chapter 16. It starts on page 537 in your book and only runs for a couple of pages. It stops kind of down at the bottom of page 540. And you'll see this in your research project as well. So this will help you guys. So 3 types of confirmations. We've got a positive blank. I think that's what number 1 would best be characterized as. A positive with a request for information to be supplied by the recipient. So it's a confirmation that's essentially blank, and you're asking the customer of your client to supply you with some information about their related account with your client. And then number 2 would be a positive confirmation. And I typically don't distinguish this in any way. I just say it's a positive confirmation as opposed to a positive blank. But a positive confirmation is where again, we're sending a confirmation, but in this instance, we're supplying information. So customer A, we send the confirmation to customer A, but instead of it being blank, we list the outstanding invoices that are shown with your audit client. And then a negative confirmation is just a confirmation. It typically has information provided, but it's called a negative confirmation because we don't ask these customers to return it. So positive blanks in number 1 and a positive where we have supplied the information. It's called a positive because we want the customers to positively confirm a balance with my audit client. We want them to send information back to us, confirming or disconfirming information provided in the AR confirmation. But a negative confirmation, the recipient is only asked to respond if something is wrong, right? So if the auditor doesn't receive something back from a negative AR confirmation, the assumption is that the information is correct. So that's why we say it's a negative confirmation. We do want them to confirm accounts receivable information, but we only want information sent back to us as an auditor if there's a mistake or an error. And we'll talk about the problem with the negative confirmation in just a second. So here are the procedures, right? You select the type of confirmation that you want to send, whether it's a positive blank or a positive completed or a negative confirmation. The auditor themselves is going to be the one that selects the sample of customers. So we're going to look in AR subledger. We're going to kind of isolate all of the non-zero AR balances. We're certainly, if your client has a list of, 1 million AR customers or 1,000 AR customers, not all of them are going to have balances, right? So we're only going to isolate the ones with non-zero balances, and then we're going to randomly select a sample of those non-zero AR balances that we want to confirm. Really important that we understand that the auditor is the one that selects the customers. We do not allow our audit clients, or we should not allow our audit clients to select which customers get confirmed or don't, right? The auditor will prepare the confirmation, have the client sign off on them, right? Just because we want our customers to know that it's the audit client that's asking for the information on behalf of the auditors. And then the auditor will prepare them for mailing, supervise the client actually mailing them out. And then we want the confirmations, if they're positive confirmations, we want them to come back to us. We don't want them to come back directly to the client. Again, we want these are external, right, documents, right? They go out of our client's organization. We have information that is confirmed or disconfirmed by an outside party, and then we want them to come back to us as the auditor. We want to keep them out of the hands of our clients so that so that we keep the reliability of that evidence high, right? If it goes into our client's hands and they have the opportunity to alter that information in any way, it kind of diminishes the value of that evidence. So we do want them mailed back directly to us as the auditor. And then if they don't return it, we'll send out second and third responses because we really want this information gathered, because it will significantly decrease the amount of time that we spend investigating AR balances. And a lot of people say, well, why don't you just replace it, right? Why don't you, for somebody that doesn't respond, why don't you just select another one? Well, there's a reason that you sent them out in the first place, right? It was supposed to be a random sample. If you just start picking and choosing which ones you're going to replace and which ones you don't, you kind of lose that randomness, and all of a sudden it may not be a representative sample. So we do, if we randomly select the initial sample, those are the ones that we want back, and we will spend quite a bit of effort getting them back. All right. So for the ones that we don't send, that don't get sent back to us, what are these alternative procedures? The most obvious one is subsequent cash receipts, right? If we show at 12/31 customer A owed my client $1,000, but they don't send back the confirmation, we'll look beyond 12/31 eventually, right? If they truly owed the balance, they will pay for it, right? People are not in the habit of paying balances they don't owe. So if there's a subsequent cash receipt for that accounts receivable, that's pretty good evidence that that was a real balance, right? The only issue, right, is that it doesn't confirm that it was a balance that existed at 12/31. So it doesn't really help us with cutoff, but it does help us with existence and accuracy, right? Cutoff could still be a problem, but we could, again, solve the cutoff issue by looking at when the bill of lading went out and when the invoice went out, and we can confirm timing of a transaction, not cutoff of the balance, right? So there are subsequent or alternative procedures that we can perform when we don't get responses back. But again, guys, look, this is time, right? Time is money to us as an auditor. So if I can look at one confirmation, right, as opposed to having to go and track down multiple invoices, multiple cash receipts, multiple bill of ladings related to that one confirmation, I'm saving time. So as an auditor, you're kind of weighing the cost benefits here, right? Do I spend the time to send another confirmation out, call them up and follow up on that confirmation, or do I go track down all the subsequent cash receipts and invoices and bill of lading? So again, the bill of ladings and the invoices theoretically some of those are internal documents, whereas that confirmation is an external document where the reliability of that evidence is higher. So we're weighing all of these time and reliability of evidence considerations when we make the decision on should we follow up more, should we do alternative procedures. And here's a good example of one of the issues with alternative procedures as well, just really quickly. So you send out 85 positive confirmations for your client, and you get 83 of them back. For the other two accounts, we didn't receive them back after second and third responses, so you do some subsequent or alternative procedures. So one of the confirmations was to Jolene Milling, confirmation number 9, and the balance that we were trying to confirm was $3,621 as of 12/31. We didn't get the confirmation back, so we look up alternative procedures, and the first one is subsequent cash receipts. And so you see on January the 15th, January the 29th, and February the 6th, we've got 3 different cash receipts. Right? The problem is that none of them match 3621. Clearly, none of them individually matches 3621, and none of the combinations match 3621. And so now you see one of the problems. At least I hope you see one of the problems. In order for us to confirm a balance at 12/31, we're going to have to, first of all, identify every single invoice that makes up this $3,621. It could be multiple invoices, right, that sum to 3621. And now we're going to have to match it to the individual invoices that these cash receipts relate to. right? It's not just that plus that, 1837 plus 1263. It's likely a portion of each of these, and maybe even a portion of that third receipt out on February the 6th. So it's, again, more work. I'm pulling more documents, investigating more documents, spending more time as an auditor, trying to track down this one confirmation. Another one, you see $2,500, and we won't worry about that one. That's an even dollared amount, and so you might have some issues with whether that's a notes receivable or accounts receivable, but I won't worry about that one. So really the point here, guys, is we spend time following up because we would really like to avoid all of the alternative procedures it would take to confirm what one confirmation would do for us. All right. And then we're going to analyze all of the confirmations, because you get kind of a wide array of responses, and we'll look at a few in just a minute. But here are some of the responses that you could get on a positive confirmation. Obviously, guys, a negative confirmation, same things, but again, if you don't get a negative confirmation back, the assumption is that it's correct, right? You send out a negative confirmation, hey, only send this back if there's something wrong, which means we assume that everything that doesn't come back is correct, right? And that's a bad assumption, right? They could have just thrown it in the trash, right, or chosen not to respond, but we're making the assumption that it's all correct because we didn't get it back. But here we're looking at things that we receive back, and here are some of the possible responses we could get. Payment has been made. Okay, that doesn't really answer the question, but okay, you're telling me that a payment has been made. Goods have not been received. All right, so they're saying, no, we don't owe this. We never received these goods. Goods have been returned. Okay, great. They've been returned, but when were they returned? Okay, there's clerical errors. Those are accuracy issues. And we're disputing amounts. That might give us a problem with unrealizable value. Realizable value. Now, these all here, right? Goods have not been received. That might be a timing issue. Goods have been returned. That might be a timing issue. And payment has been made. That might be a timing issue. So let me explain to you what I mean by a timing issue here. So again, as an auditor, we're trying to confirm the balance of AR as of the balance sheet date, right? So on 12/31, I'm showing that customer A of my client owes a balance of $1,000. Well, what if you get a confirmation back that says, no, we don't owe that $1,000. We made a payment. Well, now as an auditor, you have to ask yourself, okay, well, they made the payment, but did that answer the question? Did you owe this amount as of 12/31, right? So now you have to track down the cash payment. When did your client receive the cash payment? Because the customer might be showing that, hey, we mailed a check on, December the 29th, right? The AR balance is as of 12/31, so maybe they mailed a check 2 days before year end, but my client didn't receive it until January the 1st, right? Checks are weird, right? Checks, it doesn't matter when the check was written. What matters to my client is when the check was received. So in this particular instance, if your client didn't receive the check until January the 1st or 2nd, then your client's books are correct. But so are the customer's books, right? Because they get to record the cash payment on the day they write the check, not the date that it's received. There are no shipping terms for checks, right? So this is a legitimate timing difference where the customer's books are right? They say they don't owe the money, but your client's books are correct as well. They say that the customer does owe money, but the check was en route. So this is the legitimate timing difference where your client's books are accurate. Even though they show the AR is still outstanding, that is still an accurate AR balance. The goods have not been received. That could be a timing difference, right? Whether it's FOB destination or FOB shipping point. Most clients or most customers are FOB shipping point, so the minute they're shipped, you get to record the AR. It makes no difference when the customer actually receives them. And the goods have been returned. Again, that's another issue. When did they ship the goods? Don't really care when they shipped them. What matters is when your client received the goods back, because when they received the goods, that's when the credit memo would be issued, and therefore the AR would disappear. So it's not just enough to look at the responses. You have to analyze them and figure out if there are any issues with your client's books. So let's skip this problem 1628. You won't be seeing anything like 1628, but you might see something like this, where I just ask you if this is an issue. So you get 5 responses or come back from confirmations, and we want to know whether the confirmations retell us whether there's an issue with accounts receivable or not. So here we go. Here's our trial balance. We send out a confirmation, and so over here is an example of a confirmation on the left there. We sent it out to Atlanta Wholesale Wine. We've got, looks like 6 different invoices that were related to this one customer, and the total AR balance is $151,696.20. And you get a confirmation back. Here's what it looks like, right? There's a little tear-off perforated edge down there in the bottom. We just want them to confirm it. So you get an X that it agrees with your records, or an X that it does not agree. So this is a positive completed confirmation, right? Because we're providing the information. So I say, hey, it doesn't agree, and then there's the exception. We did not receive the shipment related to invoice 15644 until January the 1st. So our indebtedness to your audit client is 124. So they're saying this last invoice here, right, which was shipped on 12/29, right? The customer is saying we didn't receive that until January the 1st, right? So again, whose books are right, mine or yours, right? In this particular instance, this is where we would need to follow this up and figure out, well, what were their shipping terms, right? Should they have recorded it on January the 29th? If so, right, then this AR balance is good. If it's FOB destination and they didn't receive it until January the 1st, then it shouldn't be on the books as an AR. So here's the invoice. As an auditor, we'd go track this down. The invoice date is 12/29. Here's what we shipped. There's the amount, 27,138. So we don't have an accuracy issue, right? And now we're going to go down and see here are the purchase order. FOB point, it says it's FOB shipping point. So if I can confirm that this was shipped before year end, right, as an auditor, if I can confirm that it's shipped before year end, then this is a good AR. And so we go over here to the bill of lading on the right, and we see that the bill of lading date is 12/29. So this is a good sale recorded in the correct period, right? Very common for customers to not record the receipt of these goods until they actually receive it. But this is FOB shipping point. So my customer, Chateau Americana, has the right to record this sale. So even though the confirmation says there's an error, right, there's not an error. The AR records are correct. Here's another example. It says, does not agree with our records because we mailed a check on 12/30. So again, this is a difference in timing. They mailed the check, so reduced their AR balance, or sorry, it would be an AP to the customer. They reduced their amount owed, right? We need to see when they actually received it. So if you go over here to their cash receipt summary, this was for Bach Wine and Vines, and it's the first one there, Bach Wine and Vines. It wasn't received until, looks like, January the 2nd. So this is a legitimate timing difference. The AR balance is good. It makes no difference when they mailed the check. What matters is when I received it. So even though they mailed it on 12/30, my audit client didn't receive the check until January the 2nd. So as of 12/31, this was still an outstanding accounts receivable. So a legitimate timing difference, no misstatement in AR. So these are the kinds of things you need to think about, right? You might get a check mark that says it doesn't agree, but that doesn't necessarily mean there's a misstatement. You're going to have to investigate it to figure out whether a misstatement exists. Okay, I think that's enough for Chapter 16. You guys can walk through. These are the best ones right here, right? This agrees with our records, no problems. So as long as this amount matches the AR subledger, then there's no misstatement here. But I think that's enough for Chapter 16. Again, the pages that I want you to focus on are pages 531 through 5. What did I say? Don't remember. 540 at the bottom, timing. And that should be enough for Chapter 16. All right. I'll move on to Chapter 17 next.